Folks, banking season, full year earnings is here with us, and keeping with the tradition, Stanbic Bank is the first kid on the block. We are delighted to have Dennis Musau on CFO Chat. Welcome, Musau.
Thank you. Thank you very much, Julian.
Dennis, when you and I sat on the half-year numbers, I remember we had a conversation that you have stellar numbers, but no dividend. Here you are proposing 12 shillings and 60 cents per share. Quite impressive. How much was H2 a game changer to bring us to this point as far as the dividend is concerned?
Thank you very much, and thanks for having me again on CFO Chat. What I stopped at, what I didn't tell you at half year is that dividend delayed is not dividend denied. At the time, we talked about a significant growth in our loan book. We had seen 31% growth in our loan book. That calls for capital. Now, it was important that we make that decision to retain those earnings to continue financing growth. And that is why you can see that our loan book has continued to grow to close the year at 27% year on year. So part of that was actually to finance that growth. And we've been able to see that through the second half of the year. Now, when I look at the earnings, the first half was actually higher than the second half. Sure. Not because of the top line, but because on the bottom line, you will see we've taken some impairment, which I'm sure we'll speak to during this conversation. We've taken some impairment in the second half. Yep.
All right. Talking about your loan book, up by significant double digits. When I look at the deposits, up by double digits, but not as accelerated as the loan book. It puts your loan to deposit ratio at about slightly north of 80%, coming from 77% in 2021. What's your sweet spot? Where would you like this to settle?
You know, the balance between loan to deposit ratio being low or being high is really, there's an art and a science to it. If I take too much of deposits, or if we take too much of deposits and don't deploy them in loans, then we've got an earnings issue. On the other side, if it goes too high, then you've got a funding problem. So loan to deposit ratio is something that we monitor on a daily basis. We've got a dashboard in the bank that we look at this on a daily basis. But what we pay more attention to is the profile, the maturities of our deposits against the maturities of our loans to ensure that we are sufficiently funded. That said, there's got to be some form of an indicator, and that indicator for us is somewhere in the region of 80 to 90%. When we are there, we feel comfortable, obviously subject to other measures that we look at. The other thing to highlight is that customer deposits is not the only source of our funding. So we have other sources of funding that allow us to continue monitoring, continue funding our growth, our growth. And for as long as when we pull all those things together, it makes sense for us to accelerate our lending, then we continue doing that. The third pillar to this is to say, through September, deposits in the industry grew by 7%. Loans grew by 14%. So there's been a natural mismatch in the market. And our picture, which is above industry, kind of mirrors that, albeit above. But the key there for us is to say that deposits have also been hard to come by because there's yield elsewhere, both locally and internationally, which some of our price and return sensitive customers have been chasing.
Just latching onto that point of the deposits growth, as well as bearing in mind the sort of yield environment we are playing in, I'm curious, the 17% up we've seen in the deposit book, how do you disaggregate it in terms of retail, business and corporate? And why I'm asking that is because traditionally we have known Stanbic to have a very heavy corporate book, but these clients always scout for opportunities elsewhere.
Yeah. So we have three segments. So the 17% you're talking about includes banks. So let me just open up that a little bit. Deposits from banks actually increased a little bit more. When I look at customer deposits, they grew by 12%. Okay. Now, if I blow up that 12%, 11% increase in our business and commercial customers, so that is SME, which is a strong area of growth for us. About 8 or 9% on the consumer high net worth area, and true to your point, 5% on the corporate side of things, because you would expect, because of yields elsewhere, FCY FCY yields in the US increasing. There's a chase for yield, but very proud of the overall picture. To be able to grow deposits in this market at 12% is quite recommendable for us.
I totally agree. So when I look at your non-funded income, quite a checkered picture when I compare it to the funded income. So you see your expectedly FX trading income is up significantly, but when you look at your commissions from loans and advances, it's contracting. What does this mixed bag, when we look at that stream, point at?
The trading revenue line is really a strength of Stanbic Bank with regard to the sectors we operate in and the customers that we fund. We play very big in the tea sector. We intermediate more than 80% of the tea sales in this market. That is a revenue up an FX earner for us. We play very significantly. We bank most of the oil majors in this market. So that drives the trading revenue in the conditions in the market that we've operated in 2022. The fee income line is something that is a line that we pay a lot of attention to, but sometimes the trade-offs are important. One of the things we did in 2022 was to run a zero campaign on mortgages and VAF, and we ran that for pretty much the second half of the year. Now, with that zero rising of that fees, then you gain on the loan book side of things, but you give up on the fees, which if we look at the overall yield from those investments, then they make sense. The other part was 2022 was not the greatest or the most active year in terms of investment deals, partly because of the electioneering period. So we saw quite a bit of deals in the first half of the year, a little bit more muted in the second half of the year. So when you pull all that together, it explains that. Is it checkered? Not really. It's actually the market conditions responding to market opportunities, but also taking decisive actions on the trade-offs that you have to make to grow in this market.
Speaking about the dry up in the deal activity on the IB side, SBG is bleeding.
Yeah.
What's the strategy?
SBG has been hitting a couple of bumps on the road. Our business has been intermediating trading of securities. Now, let's start from the market. Trading at the NSC went down 31%. So naturally, you would expect that a player like us, who is the second largest intermediator of that traffic, then would suffer, would have reduced revenue. There is work for us to do in SBG Securities, and we have a lot of confidence in the work that we are doing there. In the context of that challenge, we launched SBGS App towards the end of last year, where you and I can, after this interview, can go in and trade shares. Where we have done phase 1 of that, which is local shares. We are doing phase 2 of that, which is to add bonds to that. We are doing a phase 3 of that, which is to add international shares. So that is a game plan to try and create more traffic and more activity for that. We are looking into other avenues. We are looking into bonds. We are looking into kind of increasing our investment type business. So you will see a lot of that come through in the next phase of this business. But a big contribution to that performance was really market conditions. By the way, even with that reduced performance, this business increased its market share. So I'm looking forward to seeing the
You
publishing.
have a bigger piece of the pie.
Yeah, a bigger piece of a smaller pie,
Yes.
really. Yeah.
Yes. All right. FX has been a big headache in Kenya, in many frontier markets. When we look at your asset quality and the deterioration by a quantum number that we have seen, what proportion of it is attributable simply to the sliding shilling?
Yeah. So our net NPLs increased from about 18 billion to about 22 billion, which is about 9% of our total loan book. Now, there is two factors there, which is the first one is what you're talking about 50% of our lending, just under 50%, about 48% is FCY. Naturally, when the currency depreciates, that number balloons. And there's a fair explanation of that, probably close to 15-20%. But the bigger chunk really was we have one corporate customer, that commercial customer, that hit a bump on the road, missed some timelines and milestones that we had agreed with them. And true to our purpose of ensuring that there's transparency in everything that we do, we took that into NPL, and that is why you can see that growing. So FX, yes, is a contributor. It's not the biggest one. A fair piece of that is also a name, just actually one name. In the retail sector, movements in and out of that, but really the big contributor is a commercial name that went into NPL.
I really thought this would be the season in which Stanbic Bank joins the 10 billion club from a net earnings perspective. I thought you would actually have crossed the 10 billion mark, Dennis.
We are on our way there. 10 billion is in sight. I can't talk about the future. I don't have a crystal ball, but we have been on a steady climb. 3 years ago, we reported a profit of 5.2 billion. Last year, we grew that by 39% to 7.2 billion. This year, we have grown that by another 26% to 9.1 billion. I'll leave it there because you can see, and we're in the same strategy. Yeah. These 2 years, these have been the first 2 years of our current strategy, which we are going. We are now in year 3 of that strategy. We're going to be revising and launching a new strategy for 2024 to 2026. But watch this space. We are on our way to that club. But what is important for us is to get to that club purpose-led. Yeah. We just don't want to make money for the sake of it. We want to rise with the communities and our customers and our shareholders and our staff. We want everyone to enjoy the benefit of that growth and not just to come and parade a big number for the sake of it.
Based on what you've said, looking at the evolution of growth in your net earnings, would you then say that it is safe to assess that the pipe fill coming from COVID-19 has finally tapered out?
I would say so, but cautiously. Remember my analogy earlier, there are businesses that were significantly impaired or decimated by COVID. People have had to do different things. So if I look at our loan book, I can't go and tell you these ones are, are under restructure because of COVID. But there are customers whose businesses were impacted by COVID that have continued to recover slowly, and we're working through those processes to ensure that they get back up. But there isn't a massive, there is no flow on the Stanbic Center, Chiromo, looking at COVID restructures or COVID type loans. We're looking at all customers in their seasons and walking those seasons through them.
What sort of vulnerability still on that line do you see in terms of what I would say your portfolio at risk in terms of the FCY-based clients who then you are seeing easily sliding from stage 2 to stage 3?
So we pay a lot of attention to how we lend. One of the principles of lending is avoiding what credit people call wrong way risk. And that is, you lend in FCY, but the revenue is in shillings. Now, historically, because the Kenyan shilling behaved like a hard currency. We had a kind of mental picture of what the exchange rate would be, predictably. We've seen more and more customers, because of the lower interest rates on the FCY side of things, we've seen more and more customers go for that. Now, because of the depreciation the currency has seen, we are seeing more and more customers coming and say, hang on, actually, I would like to convert my loans from FCY to LCY to match them with my revenues, partly because now I'm no longer getting the interest rate, the low interest rate, because of cost of funding has gone up, and then two, I'm not getting the benefit on the kind of sticky currency that we kind of had. So we are seeing that solving, and I think it's work that we're going to have to do. At 48% or so FCY book, you can imagine there's more work to be done. However, a big chunk of that book, 40% of that is oil and gas. There's a natural hedge there. Another 20-something% of that book is in the tea sector. There's a natural hedge there. So we're also managing that to ensure that we don't lose our competitive advantage in helping customers in these sectors that naturally call for FCY.
Then speaking about your heavy footprint in oil and gas, Kenya is now pursuing a government-to-government deal with the Gulf as far as oil is concerned. I'm reliably informed you have a heavy funding of the oil sector demand for dollars in this market. Do you see yourself significantly exposed should that deal sail through and oil marketing companies no longer come to you? You've been enjoying healthy spreads.
I think we need to see the national challenge that the government is trying to address and reconcile that to our purpose first before I look at the impact on our income. What has been reported in the media, which I can't speak to because of client confidentiality, if and when it comes to pass, because of our strong structuring capability in investment banking and because of our existing capability or existing competence in funding and financing oil and gas, we would like to participate and be part of that solution for the government. Now, there is demand for dollars elsewhere. We run something called a net open position, and the last I checked, we are short dollars. So effectively, we have an order book that we need to fulfill. That is not just in oil and gas. We will continue to fulfill those needs for others, even as we kind of work with the government and other players in the market to solve for the country. And for us, that is really being purpose-led, to say we will not stop or we will not kind of hold on to something just because it benefits us and doesn't solve for the country, which we are invested in growing.
Okay. Dennis, your cost-to-income ratio getting now to the mid-40s, some would say you're extracting efficiencies almost to a fault.
The industry cost-to-income ratio is actually around 40-41% if you look at the big players in the market. So there's a distance for us to still run. But I'm really, really proud. And in fact, I was hoping that we get to this conversation because I know at half year, this was 48.2. And we said that we are on a journey to 45. The work that we've been doing to move our cost-to-income ratio from mid-50s, 57% to be particular in 2019, has been informed by science and data to say where do we spend money, where do we, and how do we extract more efficiencies in those operations. And that has been both investment in external channels and internal operational efficiencies. So we launched, we launched digital customer onboarding. 95%, more than 95% of our new customer accounts, which have gone up by 19% this year and went up by 20% last year, were opened digitally. That is is not that is extracting efficiency, but really being shrewd and prudent about it. Digital lending, we are pushing a lot of traffic through our digital lending platform, and we are making more investment into that area. We've just launched Chama app, which I'm quite proud about. Now, to go around in Kenya today, statistics suggest that there is more than 300,000 chamas. To go around to each of those chamas and try and onboard them, you can imagine how many people would need. But to launch a chama app that allowed those customers to come on board and to enjoy our facilities and that is a shrewd way of also ensuring that we are efficient in the way we do the business. Now, the one thing I want to repeat to that I said in August is we're very clear that we cannot succeed because of cutting costs. So we can't save our way to prosperity. So we are going to continue extracting efficiencies, but part of that is also investing. You will see our staff costs have gone up 11-12% this year, 2021, 2022. Inflation is about 7-8%. So we've added more people to continue to increase our customer service.
I am reliably informed that Stanbic did receive its approval for risk-based pricing, and I'd like some flavor in this, and let's start with this. How are you dealing with attendant fees which was initially attached to the loan origination? To the best of my knowledge, this had been a bit of a thorny issue that banks were having with the market regulator.
We received our approval towards the end or the start of Q4, right? We've implemented risk-based pricing on our digital lending, especially for retail customers. And part of that is because it's easier, obviously, to feed that rate or to do that math in the other principle of risk-based pricing was to be able to kind of differentiate Julian from Dennis. The system and the algorithms we've built are easier, are faster at doing that, looking at various metrics. Intuitive lending, which is the manual side of things, takes a little bit of time, and we're working through that process to just be able to implement it across for all. In Q4, we were able to push more than 1 billion shillings through risk-based pricing. So that work is continuing. We see more traffic moving into that anyway because we are doing more of digital lending, but it's something that is still in the implementation stage. The fee, I didn't answer your question on fees. Fees is included in the overall price. So remember, the principle was disclose everything, so that customers were saying, you tell me the interest rate is 10%, but then on the side you're charging me an administration fee, you're charging me this. The formula we built and what we got concurrence from the central bank was everything is in one bucket, and we just charge that to the customer. We disclose it in the letters that we sign with the customers and agree on how that fee is going to be, or how that one price is going to be paid over the time of the facility.
All right. You've mentioned that you have implemented risk-based pricing on the digital lending. You're doing this at a time when we have the central bank having created the window for the credit repair framework, specifically targeting largely the digital lending. How is that interplay working?
So the central bank intervention, and again, we like looking at these things from in the spirit of what was the intention. The statistics that have been shared were that there were very, very many people that were locked out of the credit of the credit market because they were listed or they were unfavorably looked at, close to 13-14 million, at least by the statistics that were shared. The framework came in to address short-term lending, so 30 days and less, and written-off facilities, of which when we looked at in our book was very, very low, right? And actually we took a view to just forgive those customers in their entirety. We didn't even go for the 50%. We forgave those customers because it's in our interest to get these customers back, you know, to...
And you had made provisions anyway.
And we had made massive provisions for them anyway. Now, that does not negate the need for digital credit. Yeah. So the fact that you have to forgive certain customers, even without the central bank directive, we make provisions. Now, provisions is a decision to say, you know what, Dennis, you owe me 100, but based on things that have happened to you, please pay me 50 or something like that. We always forgive customers under different arrangements. So it doesn't negate the need for digital credit. Digital credit is going to be to continue being part of how banks operate and non-bank financial institutions operate in this market to drive financial inclusion, especially in the credit sector.
Okay. Still in the risk-based pricing models, the CBK now does not prescribe a ceiling. And I'm wondering, how do you go about the trade-off between financial inclusion for potentially risky borrowers vis-a-vis the fact that now it must be risk-based?
So the risk-based pricing is if you pierce through what it seeks to achieve, is to get the customers to price for their credit. So effectively, there is a price for everyone. And that is why a ceiling then is not prescribed. And the work that we have to do as banks is to really avail this information to customers to say, if you borrow 10 shillings and you return it as agreed, guess what? That is not evil. What you're doing is you're enhancing your ability to be able to borrow 12 shillings and 15 shillings and 20 shillings. And as your credit history improves and and you become more frequent and there's more data about you, then your risk profile goes down. Because what is risk-based pricing? I get the costs. We collect the deposits from the market. We pay a cost for them. We do credit administration in the office, kind of drawing facilities. And then we look between Julian and the next person and say, for you, based on your history, 2%, for the other person, based on their history, 5%. Now, if this person is able to demonstrate that they're actually even better credit than Julian, a year or two after, that 5% becomes 1%. So risk-based pricing is about empowering the customer to be able to determine their cost of credit and not the reverse.
All right. Dennis, let's close this. You've really ramped up your loan loss provisions. Please walk us through that.
Our philosophy about credit is that, and the way we operate is that we've got large corporates in one segment, we've got commercial and business customers in another segment, and we've got consumer and high net worth individuals in another segment. Usually, when you have a customer in the large corporate area or commercial customer areas, hit a bump on the road, then that you will see that come through in the income statement. What we saw then in the second half of the year, and the way we make provisions is, there is IFRS which guides it, but usually we agree, especially for customers that are in distress, we agree milestones. When those milestones are missed or something comes up that means that those milestones are not going to be met, we go ahead and make provisions. And there's three ways that we look at, generally, three types of non-performing customers, three broad categories. There are customers that have their businesses decimated completely by market events. There are customers that were irreparably hurt by COVID. There are customers that a new regulation will come up. If we had lent a few years ago to a plastics manufacturer and a regulation comes and says you can't sell plastics in Kenya, then that business is decimated. And for those customers, we have to walk through that season with them. There are other customers that go through what we call a short-term winter period. What that means is your business is thriving, but because of certain market conditions, either supply chain disruptions or if you are an employee, you've been laid off and stuff like that. You go through, but you haven't lost your skills. We expect you to get back into the market. And for those customers, we work through those seasons, either reschedule the repayments and work with them to kind of recover. Then there is another set of customers that borrow with the intention of never repaying. And
there are smaller proportions.
usually, I mean, in every market you find that. And remember, our objective in lending is to recover. So there's a difference in opinion on why we are getting into this relationship. And those customers, we have to do deep fellowships with them to try and reconcile that opinion and ensure that we're able to get back to recovery. And we have specific strategies for any of these customers whenever that we find ourselves in these situations to reconcile. But our accounting is IFRS driven. Yeah. Whichever bucket you find yourself in, if the accounting rules call for accelerated or reduced provisions, we will take them.